Welcome back to the channel. My name is Brad, and hey, we're going to do all kinds of things today. I actually have a couple slides to present today. Believe it or not, I prepared for Sunday, and we're just going to go boomers versus millennials and their view, people under the age of 40s view of the market, and people older than 40 view of the market, and why we have two different views. Those in their early mid 40s may fall to the younger side. Those over 50 fall more towards my side. But we're going to get into that and some of the other stuff. And by the way, there's a link to a video in the description from Austin Williams. Great explanation from his point of view. Yes, he's a lot younger than I am, and he has a different point of view, and he does a very good job of explaining why there's multiple views of this nowadays. And we're going to talk about that, and we're going to talk about a bunch of other stuff. I will also answer most of the questions at the end of the video, but just give you that whole perspective of what's going on. So if you didn't know, I want to add this to the stage. But let's go ahead and talk about this. If you didn't know, people over the age of 65 are having to work longer and not enjoy retirement. What is going on with this? Really, what's going on with this? How can that be? I mean, these people grew up when lower inflation, the market's gone skyrocketing. How could this be? How could something like this actually happen here in America or anyplace else, but really here in America? And that leads you into the next question. We're just going to go through these slides really quickly. In 2020, according to the U.S. government, 43% of Americans 55 to 64 had nothing saved for retirement. Thank you, Austin, for bringing this up. Literally, nothing saved. If people think, oh, I'm doing so good in the market, I'm doing this, I'm doing that, let that sink in. That 43% of Americans had nothing saved. Nothing. Wow. It's just a static. And then we're going to go on to this. So the boomers. So retirement, believe it or not, retirement, Austin did a good job on this one, is only 100 years old. Before that, retirement? What's retirement? You work until you die. Retirement was a thing. I watched Downtown Abbey, and she goes, a weekend? What's a weekend? That's the best line. They didn't have weekends, and now you guys want retirement. Oh my, how things have changed over the years. Now you want to sit back and enjoy the beach. But the earliest boomers, right, retirement, really 1935, the earliest boomers were 1946. 1946 is when they started to talk about retirement and the boomers. Now, oh, we just got to invest in the stock market. Well. 1966 to 1982. You didn't make any money. None. Let me make sure that sinks into your brain. You made no money from 1966 to 1982. So if you were a boomer, what did you do? And this is where Austin was wrong in his research, right? Because in his research, he didn't realize from 1966 to 1982, you invested in U.S. Treasuries. Yes, U.S. Treasuries. You could just go get 14% in a U.S. Treasury. Why did you have to invest in the stock market? Literally, what did you? It makes no sense to invest in the stock market from 1966 to 1982 because you could have made 10 to 14% investing in U.S. government treasuries. Or not. So that was one of the big things that he had that I just sit back and go, that's because he wasn't alive during that time period. Then becomes 1982. You sit there and go to 2000. Wait a second. There was a 1,400% increase. And remember, before 1978, 401ks? No 401ks before 1978. No Robinhood app. I'm just going to trade an option on Robinhood. No Robinhood app. No, come on. You used to have to pick up the phone, and it was one of those rotary phones. You know, the one that you used to have to like let it go and it would spin back. And you would call somebody and they would charge you 2% to buy a single stock. Because remember, indexes weren't around before 1978. What? I'm sure there's people sitting there going, I mean, SPY theoretically wasn't around before 1978? Yes, that is true. Now, you can go back and say, hey, they've done indexes to simulate SPY from 100 years ago, but it's not that old of a fund. Just throw it out for educational. You can go research it yourself. So 1978, they started doing what they call 401ks because that is when the IRS put this one little line in there. And by the way, that wasn't for you and I. If you didn't know, that wasn't for us. That was for the CEOs and high earners at corporations. But then somebody sat there and said, hey, wait a second. You can apply this to all employees. So they didn't exclude it, but it only got written in there for high earners back in 1978. And there used to be this thing called a pension. The first pension, Austin did a good research on that one. The first pension was like 1875, again for managers. You worked there 20 years and you got 50%. That was a pretty good thing. So there you have that. Now, from 1990 to 2000, the Dow went up 285, but as you put it in the NASDAQ, it went up 1,000%. Huh. That's interesting. But what happens after that? The dot-com crash. And this is why everybody in my circle community, we talk about this. How do you hedge against that? And somebody just said something about that. Brad, I've seen people buy puts in QQQ and owning YQQ for similar returns on a crash. Yes. The problem that you have is you're buying too many puts on. We're going to get into that. We're going to get into that because there's going to be, I'm going to literally show you a chart. That was a great comment. I'm going to show you a chart of you're wasting your money. Did you know that? You're wasting your money. Let me rephrase that one more time. You're wasting your money. Because if you have a put on at the wrong time, you're losing money because you're buying something. I just shake my head. Now, can you put a put on at the right time? And I'm going to show that on the chart. It's not that I have it totally figured out, but my community, I share that you may or may not want to put a put on because that is one way of doing it, or going to YQQQ. That's another way. There's also a bunch of other stuff that you can do along the way, but we'll get there. That's a great question because that is where we're going with that in today's conversation. Then the boomers, the poor boomers, here they are. They went through the dot-com crash. Now they're getting right close to retirement, and we get the great financial crisis. Great job. Wonderful for the boomers. That's why they have no money. So 2008, it just came up. It's ready for time for retirement because the earliest boomer would have been 62 years old. And you wonder why they had to go back to work, because in 2008, just after that, all of the money disappeared. Oh. So bad for them. Now, we talk about this, and this goes back to this original question. Hey, I've seen people. Well, guess what? If you would have been buying puts, well, I said, hey, here's the low. You should get back in the market. If you've been buying puts this whole entire time on that chart, you would be losing money. Yes, you would. If you would have put the hedge on where it says hedge, you would have made money all the way down until it turns green. And that's when you could have gone into YQQQ. Same difference. Same thing with the next hedge. If you would have bought a put at that time, you would have made money. I shared in the community. I back tested this for 10 years. There was only 2 times in 10 years that you didn't make money. And during the 2008 financial crisis, oh, that was even better, because during the 2008 financial crisis, it only went down like 56% according to the chart that I was using, but I was able to hedge 79% of the downturn. So that gets into the whole question. I'm going to take this one down. You can hedge not just by YQQ or buying puts. I've also done the research that I'm sharing with the community that you can actually go hedge short and long on Ethereum, Bitcoin, silver, and gold. It's out there. It is all possible for you to hedge that without having to buy a put or a call, because not everybody is able to do that. But that's not. So buying a put or buying a put on the red, closing it on the green, only 2 calls. That's the last 10 years. Now, some people can do it. Some people can't. It is all up to the individual person. That's all I'm going to say. Not everybody can buy a put or sell a call. They're not comfortable with it. My mom would not be comfortable with it. Why would she be comfortable with doing something like that she hasn't done? She was never trained on doing it. So how would she know to actually do it? That gets into another whole conversation on Monday's video. If you go back to Monday's video, this coming Monday, we'll talk about that with David Nicholas about older folks and when you might want to do something different in your financial conditions. But that is on Monday's conversation. Right. So cover calls are a hedge. Not 100%. Cover calls. You don't earn enough. Just throw it out. A put will go up in value, right? If you buy a put and the market drops, that put goes up in value. A cover call expires worthless and you get the income from it, but that put can actually offset how much your funds actually went down. That's the difference between a call and a put and going ahead and doing that. But that's a whole different story. You can also switch to other funds. So that's where that whole conversation comes up with. And I'm going to go ahead and bring up that slide one more time. The other one is things like Portfolio Visualizer were not around. When I started using Snowball, this wasn't around. Portfolio Visualizer, that wasn't around. Right? Portfolio Visualizer can go back and back test some of this stuff. And we're now getting to the point that there's enough data that you can start back testing. But if you use Snowball, which I just started using Snowball, it became a whole lot easier for me to track my distributions. So at the end of the day, and this is, I wrote some notes, and it's just because, and here, and it's, these are good notes. You did a really good job. Just because it works now does not mean it's going to work in the future. It doesn't mean that the stock market is always going to go up and to the right, because I literally just showed you on the chart that it didn't always go up and to the right. Keep that in mind. All right. Stock market is not always what you think. It has changed over time. So when people say, hey, it's gone up 10% or 12% on an average, yeah, that's true. But you had from 1966 to 1982 that it didn't. And what would you have done in retirement then? Just thought I pointed out that if you're saying, hey, I'm selling stocks to pay for my retirement, well, you would not have done very well from 1966 to 1982. That is where there's a difference in age and understanding what has happened over the years. Now, I sit here and say, hey, you might want to think about, and I keep on throwing this out, you might want to think about having some Bitcoin, right? You might want to think about having some gold. I mean, I just had a whole conversation with a member this morning, right? Back and forth on email, the difference between KGLD from Curve and IAUI. He's like, oh, IAUI is doing so much better. And I'm like, you better go back and read page 4, because there's something about that fund that you probably didn't know, and I haven't pointed it out. But Howard's going to be on the channel on Tuesday. Actually, his video will be on Wednesday, but I'm going to interview him on Tuesday, and ask him about page 4 of the prospectus, because there's a little line, this one little line, little sentence in there that will make you go, say what? It does really good in an up market. It might not do so good in a down market. Just throw that out for conversations. You better go read page 4 to get a better understanding of why it's doing so good in a up market. Because in an up market, it is going to do better than other funds. But in a down market, it may do a whole lot worse. And why would it do a whole lot worse? If you've been watching me long enough, you could probably start guessing what page 4, hidden on one little line, might indicate. And then you can just go do some math. It's literally in the holdings. I did the math last night about 10 o'clock, because I have nothing better to do at 10 o'clock at night than sit around and do mathematical calculations for ETFs and figure out why are they outperforming. $12 million in assets under management, but somehow they got $18 million in synthetics. I bet you didn't know that. I bet you haven't done the math. I bet you didn't even go look. But that's okay. That's what I'm here for. No, it's not. It's my retirement. And I'm also looking at how things have changed. I think if you've been watching me long enough, I talked about gold last December. I've showed videos on silver and holding silver, right? Now you get to go back and see everything else. I have Bitcoin, I have silver. Having those as a good base is awesome. I mean, I literally looked at a chart today, and I'm gonna go ahead and bring this chart up, going, if I would have had the nerve to go ahead and use the same indicators that I did for the stock market and shorted Bitcoin, I could reinvest that right back into BTCI and everything else, because I started looking at this a little bit harder today and came up with, let's go ahead and share the screen. I did this today and went, there was actually indicators of when I should have been hedging BTCI. Could have hedged it there. Could have hedged it there. I could have hedged it there. I could have hedged it there. And come on, what was that drop? Right? I mean, we could have literally put the hedge on at the right time and saved us 12%. Well, it doesn't quite look like that because actually your hedge, because it's using close, your hedge would have went on there and you would have took off the hedge there. So you would have saved 7.6. Just thought I'd throw that out that, hey, you can do yourself hedging even on Bitcoin and gold. And by the way, why would you? Oh, man, I need to take that little screen off there. Stop telling you guys when to do it. Yeah. Why would you be hedging gold on that way up? You really don't need to be hedging any gold as it's screaming to the north. By the way, they say gold is going to go to about $4,000. Not my projections. That's what they say. But if I put back on that little screen of hedge, look at that. Hedge, hedge, hedge. Oh, risk on. Wow. You literally can't make that up. And by the way, I share this every morning inside my circle community. Every morning. Every working day. Monday, Tuesday, Wednesday, Thursdays, and Fridays. I put these screens in of when we should be hedging and when we shouldn't be hedging. And on the S&P 500, it told us to buy here. That was Liberation Day, right? But the rest of the time, it's saying no hedge. So don't be hedging now. It doesn't make sense. Oh, by the way, it told us to hedge here. So what would have that been? I don't know. Let's go ahead and it says it there. You would have hedged here, and you would have took off the hedge there. It's only 10%, but the comment is you kept it through all this great big downturn. It just made the indication to take the hedge off on this day, and you would have done it sometime during that candlestick going up. Remember, they made that announcement halfway through the day, but it indicated the day before to take the hedge off. And how's that being possible, Brad? How can you predict the market? I'm not doing it. It was something, and this is something I've read in Jay's book, Buy and Hedge, is you can't predict the market. And I'm sitting there going, wait a second. I did prop trading for a prop firm. I'm like, no, on a longer date chart, there's actually indications that you can, at the correct moments, put a hedge on to get rid of some of this sequence of return risk. And that's the reason we're doing it, is you get sequence of return risk all the time. And now you have tools like portfolio visualizers and stuff like that, but it doesn't take in sequence of return risk. And that's why these financial advisors are telling you, oh, you got to do this and you got to do that. And that's why people under the age of 40 that's only been out in the market for the last 20 years are saying, just buy the stock market. Really? Yeah. You go back and look through history and see if that's always the case. Remember, you have all those years that you should have been buying treasuries. Somebody actually said that the other day. Oh, you should buy TLTW. And it's just like, no. Maybe when gold starts going down, that might be something you rotate into. But right now, there's an inflation risk that's out there. And TLTW will probably not be doing so well anytime soon until the inflation risk gets adjusted. And that's just my opinion. Anyway, I'm going to go back and look at this stuff and answer some questions. Right? And Punk Man, hey, always good to see you. Right? Lane, close. I'm just going to sit back and say no on CLOs safe during the rate cuts? Remember, it's floating rate. Mm-mm. Nope, nope. Yeah. Oh, here's number two. Hey, Brad. Deers in a headlight. Yes, I had deers in a headlight because when I watched Alston's video, right? He also talks about living simplicity, the simple life and how to enjoy life, right? And you really should. You really should enjoy life early because once you become 65 and older, are you going to have your health to be able to live life fully? So I had deers in the headlight because some of that data I already knew, and I knew things had changed over the years. I knew that we used to buy treasuries, and treasuries were where we were putting our money in. I mean, back in the 70s, you could put your money in a savings account at a bank and get 5.5%. Come on, you just put it in the bank, right? And they gave you 5.5% on your money. So it really makes you sit back and think about that. What has changed over the years? Frank. Hey, Frank, how we doing? M2 pulling far away from Bitcoin. Yeah, well, there's lots going on with Bitcoin. There's a lot more going on with Bitcoin than what you're seeing. You got treasury companies buying other treasury companies, companies buying treasury companies. And the question I keep on throwing out, and I'm going to throw it out again, if all these treasury companies are buying all this Bitcoin, and then not showing it to you on their financial statements or giving you the wallets because you can't go verify them, you sit back and go, are they really buying all that Bitcoin? You don't know if they are or not. Hell, they need to be third party audited, and the auditors should have the keys and be able to really have the keys, have the wallets, and be able to verify that for us. But so far, that's been a little bit limited. Just from what I've seen, I don't see a whole lot of people doing it, and that makes you wonder. Now, another one on that. In the month of August, which we're coming up to very quickly, you're going to see the market probably go up because most of the downturns never happen in the month of August. Didn't know if you realize that or not. Good afternoon, sir. We're just going to go through some of these comments. Wow, yeah, you did make it live. Thanks for being around. My retirement trading. I've seen him before. Actually, I brought him up earlier. Yeah, you can. All right. Good evening. When somebody says good evening, you know they're in one of these other countries, and I greatly appreciate you tuning in. There is a sugar ETF. I should have a sugar ETF. I mean, I put sugar in my coffee, right? My sweet tea. Actually, it's not sweet tea. It's right there, but there's no sugar in that one, right? Fructose. Yeah, that's the question about YQQQ. Correct. YQQ is a way to hedge the market in a downturn. The only thing I don't like about YQQQ is they should be paying weekly the way that they do it, but they pay monthly. And when I looked at all the downturns over the past 10 years, the average downturn of a hedge was right around that 60-day period. So you really get into how long do you want to hold it? And I'd rather be paying me weekly so I can take the income and rotate back out. But that's just me. And that's another one. So funds continue to go from revision one, which was revision one. Let's go through JEPI. You had revision one. You had a JEPI. That was the cat's meow was JEPI, right? Well, JEPI is falling farther and farther behind with all the new funds coming out. And I just sit back and go, you've got to, what worked then is not what necessarily works today. And that's why I keep on pointing out to people there's 21 funds coming out from one individual, 21 funds, and they're using a totally new strategy that really has only really started to be becoming popular right around the April time period of this year. Not last year, not 5 years ago, not 10 years ago. It's just become popular in April. Wait a second. How can these new funds come out with new trading strategies that aren't new? These trading strategies have been around forever, but they're just now coming out with ETFs on these trading strategies. So just keep that in mind as we go through revision 2, revision 3, revision 4, revision 5. Things can change over time. And being in all equities, great. But you should probably have a little Bitcoin, a little gold, a little silver. Silver is more volatile than Bitcoin, right? So Bitcoin. Silver is more volatile than gold, but platinum is more volatile than silver. And if you looked at my latest portfolio review, you notice that I hold a little bit of HODL, which is Bitcoin, and a little bit of BAR, which is gold. And I'm going to use those because when the market's going up, my account's going up with it. But when the times turn, I can sell that bar and buy the hedge to hedge my gold on the way down. So now, probably not. Probably no time anytime soon. We might not be doing hedging until next year. That's what I'm thinking. But the charts will tell me when I should actually buy a hedge, buy a put, or swap something to YQQQ or one of those other funds to do that. And that's where I'm sharing that in Circle. Trust me, I am not going to share that on YouTube. Oh, geez. The hate I get now. No, the answer is no. But you can do it. You really can. Right? What pension, Uncle Brad? Actually, that's good. That's good. I cashed mine in. I worked for a big company, and I was able to take the cash and roll it into my IRA. There you go. They were going to offer me, I forget what they offered me. I think I did the math. It ended up being I could have 6% of the notional value for the rest of my life. And I'm like, no, I can do 8. And that's what I did. Right. Huge advantage now compared to where investing. Yeah, huge. I mean, it's huge. And you could take advantage of some of this stuff with leveraged funds. Trust me. I mean, you got the new Neos Boost funds coming out. Won't give away too much, but I will probably buy them when my indicator says risk on. But until it says risk on the next indication, I'm not buying those. Scary. Now, if you would have bought, some of the round hill leveraged funds when it became risk on that indicator, you would have made a killing. You would have made a killing if you would have rotated on that indicator to YQQQ and then rotating it back to QQQI. You would have made another killing. But that's just a totally different story. But if you would have bought those round hills, those leveraged when it said, risk on at the bottom down there, you would have made a killing. That's just when you're buying at the right time. And that's where it comes down to. And that's where I go into, hey, I don't reinvest in the SPY unless it's 3.5% below my cost basis. Why should I? I'm making all the money I need. I'm taking all of it, 12%, taking all of it. And one day I will have to reinvest in it. One day I'm going to have to buy a hedge. But I'm recognizing that now that I'm a year into retirement. Well, it's not always up and to the right. We have lots of tools to do better, right? We do. The tools have changed. calls are a hedge. They are, but they're not enough of a hedge. Right? I said that because look at SPY, right? It gives you 1% a month, but if the market's down 2% or 3% or 5%, it's not enough of a hedge. But if you bought a put, that put cost will go up. So you can sell that put back out. You buy to open, sell to close, and you would have gained a premium to put back into SPY. At least that's the way that I'm going to probably play it. Hit the like button for Brad. I really appreciate that. And Brad, thanks for reading my messages. Yeah, well, I'm actually going to read all of them, and then we're going to end the live stream. So if you've got anything else you want to put in there, go ahead and feel free. I like bar, but it's at all-time highs. They still say gold is going to go up 20% from here. So, bar, why bar compared to GLD? But one, GLD is a good fund, really good, but it has higher expense ratios than bar. And since it's not paying me a distribution and not doing too much other than holding gold for me, I might as well get the lower expense ratio of bar. That's how I want to do it. What exactly is your hedge? Well, that's a great question. So my personal, this is me, this is a personal option. I will probably buying puts. My indicator tells me to buy put. I'll buy a put. I've calculated how many puts I need to protect a 100% downturn. But at the same time, if there is a fundamental change in the market, I may buy or rotate out to YQQQ. But there's got to be a fundamental change. And that's the difference of the two. Right now, we're only seeing slight pullbacks. So it all depends on where the market is. And you could use a fund like SH or SQQQ to hedge the market if that's what you choose to do, because that is not everybody is willing to buy a put. They don't want to manage it. They don't want to go through the hassles of learning how to do it. So they want to rotate to something easier like SH, which is what actually is it? It's a short on S&P 500. Yeah, it's a short from ProShares on the S&P 500. It's not leveraged. You may want to use the leveraged version, but you can rotate. These tools were not available to people way back in the day. They just weren't available, right? Sorry about the typo. I'm at work. Stop doing this at work. Red Rocket. Better off just doing commodity ETD. That's maybe, right? FTGC is the commodity the Congress is buying. I am following. That is, Nick, I'm going to go ahead and give you a shout out. Wait a second. So you can go follow, there's two ETFs out there that you can follow what the senators and congressmen are buying. And I highly recommend you go out and look at that. I probably do it once a month just to see if there's any major changes, because that will give you an indication. Maybe you should get out of something because they're getting inside information that you're not getting. So that's a good one. Brad, I hope KGLD, great fun. And IAU, just like you. However, I noticed KLG captures more upside and total returns. Looks like IAUI is going to underperform. Read page 4. Literally. In an up market, it's going to underperform. In a down market, it's going to go down harder. What? Read page 4. Bottom of the page. One sentence above the last paragraph on page 4 of the prospectus. Yes, it's going to go up faster. But in a downturn, it's going to go down faster. It is what it is. I'm a millennial. Hey, well, always appreciate this guy. This guy keeps me in check, makes me think, and keeps me in check. Right? I always appreciate him. Sometimes I'm like, I cringe when I see his post, but always he's a part of my membership, part of the community, keeps me in check, makes me think, and I appreciate that. He really does. I really appreciate him making me think. The future looks bright. I think the future looks bright until next year. Thank you, Jeff Jones. Have a great Sunday, because after this, I think I'm going to go sit at the beach. It's cloudy, it's windy, but it might be enjoyable to go sit down there. Any thoughts on FSCO drop? Yeah, tons of thoughts. So FSCO is a floating rate, and we just had rate cuts. Now, also, FSCO used to trade at a discount to NAV. This is the only closed-end fund I still hold, right? I think everybody realizes I'm not a closed-end fund person. Here's the exact reason why. It always trades at a discount. Well, the last month and a half, 2 months, it didn't trade at a discount, and it was trading at a premium. It now dropped back down to exactly where it was trading before, at a discount to NAV. And everybody's like, why? Well, that's why, right? Now, interest rate cuts is probably going to make it a little bit tighter for them to pay that 11%. And they've been doing a really good job. Am I worried about it? No, because I didn't know where I got the tip on FSCO, but my cost basis is $5 and something. All right, so my cost basis is sitting there, and I'm taking 11%. So I'm not worried about it. They do a good job. They're not over leveraged, where some of the CLOs might be a little over leveraged, but I'm not. I'm not worried about that one. I think it'll do just fine over time. But then again, I'm not worried about it because of my cost basis. I brought out some more T-SPY and TDAC. Well, they've done well. I think I made a mention of this into the membership on Monday. Tomorrow, Cy is actually coming into my Circle group, and we're holding a meeting inside Circle with Cy, so members can actually ask some questions right directly to him. He doesn't do too many live shows, if you didn't know. I already own SPY-I and QQQI. They've done well. GPIX, GPIQ, cover my basis. Yeah. And don't forget that I pointed this out to somebody on X this morning. Eggy and Eggs and EQ. I said, somebody's watching too many of my videos, because his whole list, I've done a video on every single one of his funds. Right? You're welcome. Hedge by using QQQH. Very good. They have those protects. Very well could. That could be a very good hedge. All up to you and your style. If I wasn't able to write my own puts and I wasn't comfortable at it, then yes, QQQH could be a good way of doing that. Absolutely could be a good way of doing it. No question. But I'm comfortable at doing my own puts. And that's really the difference. Now, am I telling everybody that they need to become comfortable doing their own puts? Well, it's not for everybody. It's really not for everybody. And there's other ways of doing it. But QQQH, great fun. Another way to hedge the downside. Really is. Of course, 1982 was a big year for investing. I was born then. So he's only seen an up market. Right? 1982, right? So keep that in mind. That's where we get some of these people not thinking of this, right? Yeah, there you go. There's the two that follow. I go out every month or two, go look at them to see what they hold. Literally see what they hold, right? See that they hold Nvidia. When I see them all selling Nvidia, I'm gonna go, whoa, what do they know that I don't know? Because that is a good way of doing it. Oh, that's a good one. I'm sorry to hear that. KGLD. Maybe that's where you have the letters mixed up. It's KGLD. Go check it. Uh, Leave a comment down below if you can't find it, because I'm talking to Curve on Tuesday, and I will make mention to Howard directly that you couldn't get that, but it is KGLD. Just for your thoughts. Any thoughts on BTGD? If you were into the growth side, you could hold that for your growth. And I've thought about that. Right? $1 equals $2. Right? He definitely has something going on there. They rebalance. So right now gold is going up. So they're reducing their gold holding and investing in Bitcoin. And when Bitcoin goes up, they'll reduce the Bitcoin holdings and put it back into gold. Really, really good. And the last question down here, is it just me or GPIX and GPIQ have very low distribution return? Yeah, they do. They literally target that. They target those distributions. And by targeting the lower distributions, you get more capital appreciation. There's no free lunch, especially the way that they're doing it. So, yes, they're going to have lower distributions, but they're going to have more capital appreciation. Depends on what you want. Right? A lot of us look for my distributions and want some capital appreciation. Some of these funds paying these high rates, what they call NAV erosion, we just don't like that because that is not psychologically how our brains are wired. So we really switch that. And that's why a lot of people like the GPIX and GPIQ, because they do have that capital appreciation. When I switched from growth to income, so do I need to work at a part-time job running the Tesla wave? Well. Depends where you are in life. That's all I'm going to say is all up to you and what you do. I'm going to say, hey, if you're going, part of your retirement plan should be, what are you going to do in retirement? Going to live like me down at the beach. If I didn't make YouTube videos and have something to do and keep me active all the time, I probably wouldn't last very long. But now that, hey, I got stressed and hey, I got to get ready for the video, get myself going, answer comments, keep myself busy, gives me something to do in my retirement that I enjoy doing. And I can also turn off the switch and go sit at the beach for a couple hours. And that is the lifestyle that I want. Retirement isn't just doing nothing and watching TV all day. Even though, if you do know this, Big Brother is going to have its closing, and I watch Survivor. Who doesn't watch Survivor, right? Come on, it's a great show. Did you know? Here's one. Did you know that I applied for Survivor? How about that? Maybe one day. Maybe I'll reapply one day. True. Hello from California. Ooh, grab that coffee. Yeah, it's time for coffee. I noticed Tap Alpha funds, T-Spine capture more capital appreciation than all but the to April 9th. That is when T-Spy did not get the best in capital appreciation, because you had somebody come out in the middle of the day and say you need to buy the stock market, and the market shot up and he missed about 3% that day, right? So he does do a really good job. Just want to give you a thanks on SLJY. How about that one? SLJY. If you weren't watching that video, and by the way, that will be Tuesday's video of following up with that. I mean, it was like a 19% distribution rate, and it has captured capital appreciation. And I bought the sister fund that's uncapped, and it's up like 7% on top of it. All right. Yeah. Yeah, that was a good fund. It's a little more riskier play because it's on the miners. But then again, I literally have a chart of when you should actually be hedging. And I'm going to be hedging silver too. So when I got silver going to 200, not 200, 125 to 150 is what they say. So it's 3x from here. But what do you do after that? Do you hedge? What do you do? So it's always something to think about, right? I retire 2 years from now for a 35-year career with a pension. Congratulations. Work part-time at home improvement retail, 12 to 32 hours a week. More in the summer, less in the winter. You're right. You do need something to do. Yes, you do. Yeah. So I want to end this with this little thing that I saw when I was out in Nevada. So I went out to Las Vegas for business, and I was staying at one of the casinos, and I did valet parking because, come on, my company was paying for it, so why not have valet parking? And I met all those guys, and we were just sitting there chatting, and they go, "We're all retired." And I'm like, "No, you're not retired." He goes, "Oh, yeah, we're all valets. We're all in our late 50s, and we only got a couple more years until we all collect Social Security, and we're all walking out at the same time." And I looked around, and they're all were about my age. So they had retired from corporate jobs, but they were running around doing valet parking because it gave them something to do before they pulled that final, "Hey, I was going to actually retire." All right. Something to do. Just everybody to your house should be keeping you busy. Well, there's a lot to that. That's a great big comment. So yes, doing all kind. I mean, you could do all kinds of things in retirement, right? Make a goal, stick to it, do something out there that you enjoy. So, thank you for coming along and enjoying this Sunday with me. Make sure you limit your coffee intake after lunch because you don't want to stay up all night, especially when you get older. And have a great weekend. And God bless.